Okay, well, my presentation today is called The Great Rotation is On. What that exactly is, I'll talk to you about it in a second. I am vying for the title of the world's greatest stock trader, but I don't think I'll ever get as close as Jesse Livermore, because they didn't have an SEC when Jesse Livermore was around. Insider trading was rife in those days. Why listen to John Thomas? Well, I've been at this for half a century. No, I wasn't really trading with Jesse Livermore in the 19th century. I spent 10 years as the economist correspondent in Tokyo, Japan, and later the White House under good old Ronald Reagan. I spent 10 years running the international equity division at Morgan Stanley. Took a little vacation as a Marine combat pilot in Desert Storm. Only got shot down once. Still set off metal detectors as a result of that one. 10 years running the first international dedicated hedge fund. Retired from that, then spent 5 years fracking for natural gas. This was in the late 1990s. Everyone said I was crazy, especially the oil majors. And then 9 years publishing the Diary of a Mad Hedge Fund Trader. I'm one of the handful of founders of the modern hedge fund industry who's still working and still breathing. This is the other reason you want to listen to me. This is my trailing 12-month performance. We are up 56.40%. Since a year ago, and this is a typical hedge fund type performance. When there's nothing to do, we go sideways. When we see an opportunity, we get a gap up, sideways, gap up, sideways, and then a massive gap up when everyone is looking the other way. Was I lucky this year? Did I have a one-hit wonder? Well, this is the 7-year average daily performance, works out to 32.45%. If you are not happy with making 32.45% a year, you can skip the rest of this webinar. If you are interested, then listen on. I do get around the world a lot. This is a skeet shooting championship in New Zealand I was at a couple of years ago, or not a couple of years ago, a couple of months ago. And I got first place, got a bottle of champagne, and good thing I didn't tell them I went to the Marine Corps sniper school at Camp Pendleton. They might have given me a serious handicap if they knew that. If you are not up 56.4% in the past 12 months as I am, you are reading the wrong newsletter or following the wrong trade mentoring service. Of course, here's my secret weapon, the Mad Hedge Profit Predictor, my market timing index. This is an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators 24 hours a day. And this was our indicator as of the Friday close. It's showing that we are in buy territory. When we're getting up close to 80, that's a sell or sell short territory. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 30 times a day. Don't go to a gunfight with a knife. You are trading against algos, you will lose. Algorithms provide you with a defined, systematic trading discipline that will enhance your profits. This is a compilation of the buy and sell indicators for the S&P 500, which we've gotten over the last 3 years. Every time we get to strong buy territory, we knock out trade alerts to buy stocks. Every time we get up into sell territory, we knock out trade alerts to go short stocks. And as you notice, we get several buys and sells a year. Right now, we're under 20 or around 20, which is strong buy territory. Let me give you an example of how this works relative to the S&P 500 over the last 3 years, which was up 39.53%. We were up 106.21%. Using our market timing index, which is 2.69 times the S&P 500. Notice we've just had a massive spike up in performance in the last few weeks. I'll give you a couple of typical examples. Last summer, we got a very strong buy on financials We bought Goldman Sachs. We got a 85.71% return on that. Then we got the sell signal in March, once it was clear that the Trump economic program was going nowhere. So we took profits. We got back in about a month ago, again on the long side, and here the market is starting to discount a tax package that'll happen sometime in 2018. This is the most interesting chart of all. This shows that my market timing index predicted correctly who was going to win the presidential election before I did. I was wrong. I expected Hillary Clinton to win the election, as did everybody in the industry. But my market indicator knew otherwise. It was saying buy U.S. steel 8 days before the election. So what do? We bought U.S. steel. We got 162% return on this in just a couple of months, almost a triple. And then it took us out, right? When everyone was super bullish about the future of the economy and deregulation and tax cuts and healthcare, our market indicator said sell, get out. We're overbought. We're due for a pullback. So we got out, and we got quite a big pullback in Goldman Sachs, nearly 25% at one point. We got out, and then we got back in again this summer. So in, out on a stock. We've made a ton of money on a stock that's basically gone nowhere for a year. Look at this, March 2016 to today, the stock is unchanged. Method to my madness. In the last month, I moved from 100% cash to 90% invested with a 10% net short now that volatility has sharply increased. Risk on means buy gold and U.S. Treasury bonds on dips, sell stocks, soft commodities, and energy on rally. Almost all asset classes and sectors are still at the extreme end of 2017 ranges. The world finally wakes up to geopolitical risk with North Korea, and there is no sight of it ending anytime soon. FANG will lead the downturn in any stock market correction. I'm looking to sell the next big oil rally in oil, and I'm staying away from the currencies until we get a definitive bottom on the dollar. I do tend to get around a lot so I can listen to customers, pick up good research information. And I usually spend a couple months every summer in Zermatt, Switzerland. In fact, I just got back. This is me looking at the Matterhorn, watching climbers come down from the summit. By the way, I do climb the Matterhorn myself at least once a year, just to prove that I can still do it. Portfolio view, what's changed? Volatility index has just seen the sharpest rise in history. This has spilled over into the options market and made all options-based strategies much more profitable. In fact, almost twice as profitable as they were only a month ago. This justifies a larger and much more aggressive trading book, and that's why I went from 100% cash to 90% invested. One of my hobbies is flying antique aircraft, doing aerobatics. I've been a combat pilot for 40 years. And in this particular picture, I'm flying a P-51 Mustang. That's a World War II fighter over Florida. If you don't know what a P-51 Mustang is, this is what it looks like. It's kind of a cross between a jet engine and a piston engine. It does about 450 miles an hour. Quite an amazing plane to fly. Global economy, we are now seeing a global synchronized economic recovery. That should be the primary consideration in all of your sector and stock picks right now. We got a July non-farm payroll report that was a hot 209,000. ADP up big. Unemployment is at a decade low at 4.3%. U.S. GDP was revised up from 1.2 to 2.6%. June durable goods up a massive 6.5%. So all positive. China is hitting all cylinders at a 6.9% growth rate. And we basically have China, Europe, and Japan pulling the U.S. upward. They're acting as the locomotive. We are the caboose. This is all very, very stock market friendly. Stocks, the correction is here. Stocks normally get 5% pullbacks every year, but we haven't had one for 18 months. Current correction so far is 3%. We may get another 1% and then another 1% spike down and a hard bounce in one day. That's usually how these things play out. Second quarter earnings were expected at 7%. Instead, we got 12, sending indexes to record highs. Q3 earnings are now being revised upward as fast as the analysts can write them, topping of fangs in the bottoming of the US dollars, leading to aggressive rotation into financials, gold, metals, and industrials. Out with the old, out with the new, and in with the old. That pretty much describes our current trading portfolio. We did get a massive short squeeze in volatility, up 70% in 2 days. We caught that perfectly at the bottom with a bunch of call options, and we got doubles on those call options in 2 days. That was the best trade of 2017. However, there is no real crash coming, as there is nowhere else to go with your investment. So look for a 10% correction at the most, and you need a major geopolitical event even to see that. We are still in a long-term bull market that has a couple years to go at least. Looking for a 10 to 12% total return in equities for 2017, but we may have to see the correction first. Here's the S&P 500, peaked at 249, saw a low of 241 and change. The extreme low in this move probably is going to be about 236.5. If we see it down there, look for the first major support around 240. In fact, that could have been a successful test of the 240 level right there after we rallied strongly over the last couple days. Here are a couple of long-term indicators showing that the market is expensive. This is the Buffett indicator. It's a ratio of corporate equities to GDP. And you can see we are at a top, which we've only seen 3 times since 1950. We saw one in 1968 when the Nifty 50 peaked out. That's when I first got in the market. Of course, there's the dot-com boom at 2000. And now we have a new peak right here. So all this means is be careful. Have that downside protection in place. Run market neutral portfolios. That way, if you get whacked, it won't be a big one. Here's another one showing the ratio of equities to commodities. It's showing commodities are also at a half-century bottom, only seen 3 times since 1971. And our portfolio on the long side now is overwhelmingly in commodity-type stocks. I'm talking gold, copper, iron ore, U.S. steel, that kind of stuff. This is the bargain of the half century, quite literally. And the way commodities go, once they turn, they can rise very sharply. And this may manifest itself as rising commodities and falling stocks at the same time. This is certainly what we got here, here, and here. 10 reasons why there will be no 2017 crash. U.S. stocks are still one of the highest yielding asset classes in the world with a dividend yield of 2.5%. Oil prices are still less than half they were 3 years ago and a third of where they were 5 years ago. Weak yen and euro are stimulating Japanese and European economies to buy our exports. While U.S. interest rates are rising, they're doing so at a snail's pace. Technology everywhere is accelerating, boosting profits. Stock buybacks and M&As are shrinking the supply of stocks. Tax cuts will kick in eventually. So will big infrastructure bill. And there isn't going to be a trade war because the U.S. government has to borrow half of all of its new debt from, you guessed it, China. Technology lives. If you really want to be lazy and have a one sector portfolio, it's going to be technology. Eventually, the entire stock market becomes a technology market. Right now, tech stocks are about 25% of the S&P 500. Just don't forget to buy on every 30 or 40% dip, which we seem to get every couple of years. They will benefit the most from any cash repatriation plans, which will be part of a new tax bill. Apple alone can bring in $246 billion to buy its own stock. Microsoft, Cisco, Amazon, or other really big names on that list. Hyper-accelerating new technologies mean that profits will keep growing at 20% a year, no matter who is in office. TechMate's a great hedge against domestic plays. Big institutions and hedge funds are loading a boat in tech on every dip. Here's the triple Qs, the NASDAQ ETF. And you can see we're not really getting much of a correction here. What's happening is we're getting sort of a sideways move, which could continue for weeks or months more. And then I expect another blast up to the upside, possibly going into the end of the year. Of course, we've been very active traders of Facebook for many years. This shows you our recent buy and sell indicators. Bought at the beginning of 2016, bought at the beginning of 2017, and we came out of all fangs in July, right when they were peaking out. Again, thank you, Mr. Market Timing Index. Apple, same deal, very strong buy in 2016 in the summer. Got a near double on that. We got up very close to 160 on that. We came out again in July with all fangs. Alphabet, same deal. I actually know Google quite well, as they're literally just down the street from me. I have seen their operating system, which they're going to launch 5 years from now, and you won't believe what's coming your way. Again, double on this one with a buy there, and then we came out and took profits in July. Amazon, I work with Jeff Bezos at Morgan Stanley. He was the head of our bond research department. And when he told me he was starting a bookstore, I said he was out of his mind. When he said he was going to call it Amazon, I said I was really sure he was out of his mind. What a stupid name for a bookstore. And boy, is he laughing all the way to the bank. Guess who has the spacecraft, the space program? I don't. That's the hint. Anyway, we got a buy here, and then we took profits on all fangs in July. Europe, hedged equity, we've been out of this year because the euro is going up all year against the US dollar. That acts as a drag on stocks in Europe, so we are staying out. Same with Japan, taking a rest because of strong yen. Tesla is one of our favorite stocks. I've been following the company for about 10 years. I bought 3 of the cars myself. Our original cost on Tesla was $16.50. So it kind of makes the run just short of $400 really nice. Most recent buy signals we got were here, back at 140, here at 180, and then we came out right when it hit 390 in the spring. We're out of the stock right now. This is my latest Tesla. That's the $149,000 fully tricked out Model X with the ludicrous mode that gets you from 0 to 60 in 2.9 seconds. The doors each have their own private algorithm, and the kids love playing with the doors, opening and closing them all day long. That's my first Tesla. It didn't turn out so well. This is chassis number 125. Yes, it is one of the original S1s produced, but no matter what Tesla does, they can't protect against a pickup truck driven by a drunk driver on Christmas Eve who tail-ended me. It's kind of interesting to see how the car is made. This is a 1,200-pound lithium-ion battery under the back seat, which gives you a 300-mile range. In 10 years, this will be a 100-pound battery under the back seat that takes you 300 miles. Over here, you can see the carbon fiber honeycomb around the wheel wells. It does make it the safest car in the world. I just got out of the car, took a picture of the guy's license plate and took off. Called an Uber cab and went home. Told the insurance company where to pick it up. Bonds, we are seeing a flight to safety. Even though interest rates are going up, bonds are going up even faster. Makes no sense, but that's the world we're in. Breakdown in global inflation to an 8-year low triggers a new bond market rally. Fears of nuclear war send cash from stocks into U.S. Treasury bonds. The nice short is setting up in bonds. Could be the big trade for the rest of 2017. Wait for a spike bottom in the stock market before going short bonds in a big way. When you get that signal, that'll be a very clean trade to go into. We are back to the bottom of a 210, 240 trading range. 213 could be tested this coming week. We are 10 months into a 10 to 20 year bear market, so now is a great entry point on the short side. And by the way, if you have any questions on any stocks, any asset classes, just type it into the question box, and We'll get to those later on in the webinar. We got a strong sell signal on bonds a year ago in July, went short, and we shorted every one of these little rallies, covered down here, and then we started shorting again over here. We're out now of the bond market. We're completely flat, waiting for the next spike up. Currently, we're trading close to 128 right now. This is the inverse of the bond trade. This is the TLT. It's a bet that interest rates will rise. We got a strong buy signal there also a year ago, and another one just a few weeks ago. So buy the TLT for the long term. Buy every 5-point dip for the next 10 years. Doesn't get any easier than that. Weekly jobless claims, it's the most important economic statistic of the week. Got to a new all-time low at 234,000. There is a tremendous job shortage right now. You can't hire anyone if you're looking to expand your company, especially if you're trying to expand online like me. Foreign currencies, we're seeing a flight to safety there too. Korean war fears finally give flight to safety bid to the US dollars as traders take huge profits in the yen and the euro. Profit taking overwhelms any negative effect of lower interest rates. Japanese yen and euro take the first serious break of 2017, but there is no conviction in the move so far. Get ready to sell short the yen and the euro on a blow-off top, which will happen when U.S. interest rates break out to the upside. However, this whole scenario is on hold as the stock market correction unfolds. So give it a few more weeks to burn out, then we may have a great shorting opportunity on euro and yen. Here's the UUP, US dollar basket. Trying to put them in the bottom here, but I'm not convinced yet, so I'm holding back. If this continues to rise, the whole domestic metals, gold, copper story in the US will continue for the rest of this year and probably well into next year. Japanese yen getting ready to go short here. You can see why I'm tempted right up to a triple top. Euro also approaching multi-year highs here. We did get a nice sell there. We covered there, and since then haven't touched it at all. Waiting for this uptrend to burn out. We still think long-term the euro goes down. Plus, we had much better plays in the stock market at the time. Energy, we're at the top of a down channel. Storage wars end as oil contango shrinks, signaling that prices may remain here for a while, ending the oil short play. However, much of the recent buying has been short covering only and may have exhausted itself at a channel high. Chinese oil inventories hit all-time highs. They are the world's largest marginal new buyer of oil. OPEC production is still rising despite quotas. The latest OPEC, non-OPEC meeting got nothing. Bottom line, a whole lot of supply is about to hit the market. And currently, the hurricane is going through our big oil producing regions, so we may get a brief price spike off of that. I'd probably be selling into that. When you say top of a down channel, it doesn't get any clearer than that. So again, wait for another run up and then go play short. Precious metals are back in the spotlight. Flight to safety bid finally finds gold and other precious metals. India also reemerges as a major buyer. Watch the perfect inverse correlation between the fangs and gold, making the barbarous relic the perfect hedge for long technology portfolios, which pretty much everyone has. Decisive break of 1,300 an ounce could tack on another $50 to gold very quickly. Bond rally that lowers interest rates is also gold positive. Bitcoin bubble is peaking, leading to a sharp sell-off. Stay away. Time to load up on gold and silver stocks, at least for the next 6 months, as the move is still only a few weeks old. And that's me doing some early Christmas shopping in the Istanbul gold market. I do tend to get around a lot. Gold, we got a big buy signal at the end of last year, took profits here, and we went just back in a couple weeks ago here on the long side, and that one's already making money. GDX got the sell here, got the buy here, and looks like we're going to take a run at these old highs up here. So big money still to be made in the gold miners, and the same with the world's largest gold miner, Barrick Gold. We got a buy signal here at the end of July, and we're still running that long. Bitcoin gone from $1 to 4,200. Stay away. If your money gets stolen, there's no 800 number to call to get it back. Very high risk, very speculative. You can do it with someone else's money, not with mine. Real estate is still bid. Home sellers seeing the highest profits in a decade. Average residence is now 8 years in a house, used to be 4. That's the longest in 20 years. 29% of all homes now sell for cash, up from 27% a year ago. A lot of that cash buying is from foreigners. New June home sales are up. Home builder sentiment is up. Medium home price up 51% since the 2009 bottom. And on the coast, it's more like 100%. Bond rally gives the refi boom another leg. S&P K-Shillers staying strong, showing 5.6% annual gains nationwide and 10% in the hottest markets like San Francisco, Seattle, and Portland. Your home equity could be the best investment of the year again for the 5th year in a row. Home Depot, this is one of our favorite longs here. We got in a buy signal here, and we're already making money on it. Average existing home prices about to break out to new all-time highs nationwide. Here's another one, the Home Construction Index. That's a basket of major new home builders. We got the buy signal right after the election there. This was another Trump rally stock, and except that this just kept on going. Trade sheet, what do we do about all this? Stocks sell for the very short term, buy for the long term. Bonds sell the rallies, commodities buy the dips. Currency sell the rallies, precious metals buy, and real estate buy. Here's the really long-term view. Here I am back in Switzerland again. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age in the United States. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. In the meantime, central banks will bridge the current 2008-2022 demographic drawdown with aggressive monetary policy through QE. The last time this happened was from 1982 to 2000, and we got a 20-fold increase in the Dow average. That's what happened the last time we got a demographic push like the one that is just starting, 20 times. So that's why I say making money in the 2020s will be like falling off a log. If you want to know how to make money from this coming golden age, you have to sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top performing mentoring service in the industry. Up 56.4% a year in impossible markets. Follow my research and market beating trade alerts, and you will rake the profits in. By the way, that's my U.S. Marine Corps pin, in case anybody asks. Here's our 1-year trading performance. I showed it to you before. Just had a massive spike up this month going long gold and the metals, and we look to maintain that for the rest of the year. Let a Marine combat pilot steer you to big profits. And no, that is not the plane I flew in Desert Storm. This is another one of my favorite vintage aircraft. It's a 1932 de Havilland Tiger Moth. Note the design flaws, like the gas tank sits on top of your head and the plane has no brakes. It just has a tail skid, so you have to land on grass fields to slow it down. But it is an awful lot of fun doing barrel rolls, loops, and spins in that plane. It's made out of Irish linen and Norwegian spruce. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical trading month we had in January. Shows we're trading everything all the time from the long and short level. Here we bought the S&P 500, made a 16.3% profit, went short treasuries, and then bought the Russell 2000, Amazon, Apple, and Biogen. We then stopped out of Biogen very quickly. We always stop out quickly. That's easy to do when you know that 90% of the time your next trade is going to be a winner. We then bought Palo Alto Networks, sold the yen, sold treasuries, bought the S&P 500, and bought gold. And 90% is a very typical win rate for us. At least that's what it's been for the last 10 years. This is how it works. I issued a new artificial intelligence report on November 2nd last year for NVIDIA. I then shot out a trade alert. It said, NVIDIA, buy NVIDIA shares at $68.57 a share or best. To get a $10,000 weighting, you need to buy 146 shares. What happened? We didn't just walk away from it like most newsletters do. In fact, we got a move of up 78.5% in 2 months. Did I sit in my laurels and pat myself on the back? No. I sent out another trade alert. Take profits. Sell NVIDIA shares at 120 shares, $120 or best. And in this particular case, we made a profit in 2 months of $7,508 on a $10,000 investment. Got a couple testimonials here, and let me read some questions that have come in. Jeanette, if you have any other questions, feel free to jump in. Dan in Topeka, Kansas, what's the minimum amount of money I can start with? Dan, I'd say $5,000 to be safe, but I've seen people do it with as little as $400. That's how much one share of a single position in our strategy will cost. We literally have students in dorm rooms trading off their beds. Joe in Detroit, Michigan, I've never done this before. Can a beginner start with no prior experience? Absolutely, Joe. Bringing beginners into the market for the first time is one of the primary goals of this service. Let me go on. This is hiking in Switzerland. Here's another testimonial, another question. Mary in Kansas City, Missouri, how many trade alerts do you send out a year? Mary, we do about 250 a year. Depending on what the market is doing. I can send out none for 2 weeks, then you might get 5 or 10 on a really big day. You don't get sweet spots in the market every day. We tend to focus your attention on sweet spots only. With my Global Trading Dispatch service, you get a daily research newsletter giving you the deep background on all the trades and economic trends in play, true hedge fund manager analysis that others pay thousands of dollars for. It really is a global 30,000-foot view. Instant trade alerts texted to you at market sweet spots. It takes about 5 seconds for them to get from me to you. Live bi-weekly global strategy webinars like this one. Take the Mad Hedge trading staff, combine 100 years of trading experience and add it on to your own. And I'm 50 of that. 100 years, the other 50 is spread out among 3 other guys. Invitations to strategy luncheons around the world. We do around 25 a year and unlimited access to our 9-year database. I'll also give you a tip on a great surfing camp in North Africa. However, it is much harder than it looks. If you don't believe me, here's another testimonial, and I'll take another question here. Let me just scroll through here. Cheryl in Fort Lauderdale, Florida, how do we find out your current trading positions? Once you become a member, we post them on the members only website, and you can access them 24 hours a day. Let's see. Here's one from Robert in Seattle. You obviously have enough money. Why are you doing this? Well, Robert, thank you very much for the compliment. Teaching people how to make money and secure their financial future is the love of my life. When I was on Wall Street, I used to see so many people get ripped off by brokers. It made me sick. This is my chance to level the playing field for the regular guy. And this is me and my, I have another office in Incline Village, Nevada. That's right on Lake Tahoe. Did I say I get around a lot? I can't remember. Yeah, one more testimony, and I promise that's it. By the way, these are real black swans in New Zealand. Notice I'm keeping my distance because they bite. Ivan in Portland, Maine. How would you describe your trading philosophy? Well, Ivan, I use fundamentals for the long-term call and technicals for the short-term call. It's what every long-term professional does. Here's what I'm not going to charge you for my service. I'm not going to charge you $100,000 a year That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000. That's what I charge my invitation-only concierge clients who get my personal cell phone number so I can act as their investment 911. And I'm not going to charge you $5,000. That's what we charge our advanced option trading clients. I'm not going to charge you $3,000. That is the cheapest price you will find on my website, $3,000 for 1 year. Not for you. Creating this product cost me millions of dollars. With the best customer service in the industry, running it cost me millions more. Today and only through this webinar, I'm offering you 3 months for just $497. We almost never offer this price. Jeanette twisted my arm to get the best deal for her customers. This is the only place you will see this offer for $497. Everyone else has to pay $3,000. I can do this because I know when it comes time to renew, you'll happily pay the full $3,000 because you've made so much money. Just click on the link in the chat box on the right to get to our exclusive sales page, and that will take you to the page. Also, if you subscribe today, you will get a copy of our book, $49 in the store, Stocks to Buy for the Coming Roaring 20s. These are all the single stocks and sectors to buy and forget about for the next 20 years. Buy it now because 3 of these stocks have already doubled since the book came out. So get it for free before the next double, free with your subscription. Here's the offer you can't refuse. 3 months for just $497. Let me show you how to make the money to pay for your own subscription. Just click on the chat box on the right, and that will take you to this one-time only exclusive offer. And now I'm ready to take more questions. Jeanette, have any questions come through on your side? Okay, here's one that's coming through. Joseph in Portland, Oregon. Can we talk to you directly? Joseph, I spend part of every day calling readers and looking for ways to improve the service. You can email me at any time, and I always answer the same day. You can also get a chat box on my bi-weekly strategy webinars just like this one. Type in the questions, and we try to get to every one. Jim in Dallas, Texas, are the trade alerts for stocks, ETFs, or options? All of the above. We send out a range of possible securities with every trade alert so readers can tailor it to their specific needs and risk profile. So every alert includes a stock, an ETF, or an options trade. You get to choose. You get to decide how much risk you are willing to take. Joel in New York City, how often is the newsletter sent out? Joel, every day the market is open, about 250 times a year, or every day the market is open. Let's see, what else have we got here? Okay. Let's see, Robert in Kansas City, Missouri. Will there be a recession? Robert, not this year, not next year, possibly in 3 years. That's how long it will take interest rates to rise enough to really hit the economy. Until then, it's happy times. I mean, buy the dips, sell the rallies, play the long-term trend upwards, and use the next big dip in technology to really load the boat in technology and biotech. Those are the 2 sectors that are going to see us through for the next 20 years. Let's see, any other questions? George in Austin, Texas. Well, first of all, George, I'm amazed you got through with this hurricane on. I guess Austin is far enough inland, so you're just getting a strong wind. We send out the news. We put the newsletter to send out at midnight every night for the next day. so it's in your inbox for the next trading day. So you can act on the advice immediately. Philip in Boston, Massachusetts, can I talk to a current user of your service to get their opinion? If you go to our website at madhedgefundtrader.com to the testimonials page, you will find hundreds of comments from current subscribers who will relate their experience over the past 9 years. What you will not find on my website is the $497 offer. That you can only get right here, right now, courtesy of Jeanette. Jim in Palo Alto, California, are you an algorithm? No, Jim, but I play one on TV. Now, if I knew a good machine noise, I would make it right now. How about whir? That's kind of machine-like. No, if you want to see me in person, come to one of our 25 global strategy luncheons a year. Pinch me, and if I'm bleed, you know I'm a real person. Let's see how we're doing here. Okay. Nigel in London, England. When do we see a return of inflation? I am long the TVT. Well, good for you, Nigel. TVT is going to be a great ETF to own for the next couple of years as interest rates rise. If we get an infrastructure budget and a tax cut next year, both of which are highly inflationary in a full employment economy, we will start to see wages rise sharply, which is far and away the largest component of inflation. Millennials with large pay increases will become big spenders. And when you start hearing about friends getting out of the blue surprise 10 or 20% pay rises, then you know inflation is here. We haven't seen that in about 10 years, but it is coming back. Roger in Richmond, Virginia, do you offer training with a subscription? We include more training than you could use in a lifetime with books and training courses. Every trade alert that goes out comes with a link to a video on how to execute it on your own trading platform. And if you have a question, just email me. We answer all the emails that come in every day. And sometimes we get great trading ideas from those emails, like, why aren't you looking at this, for example? I think, holy smokes, why don't I think of that myself? And I'll knock out a trade alert. So 3 months for just $497. Click on the link on the right, and that will take you to our exclusive sales page. Okay, let's see if there's any more questions here. Just let me scroll through the question box. Jim in Houston, Texas. Well, I'm even more amazed that you got through. Has oil bottomed? Yes, but it'll take a while to get to over $55. That's where big U.S. fracking supply kicks in. You should be buying long-dated calls on the USO on any substantial dip. When I mean substantial, I mean like down to 45 in the price of oil. Gary in Garden City, New York, what is your best stock pick of the market right now? I would have to say GDX. Gary, gold is about to break out to the upside. It's going to break out through a resistance point that's held for 2 years. When that happens, you can get a sharp move up on large volume that will drag all the ETFs and stocks with it. We're long all of these things, so you could participate by buying the GDX, which is the gold miners ETF. The ABX and Newmont Mining is the other big name in that sector. And we're in fact long all three of those right now. Let's see, Roger in San Diego, California. Where do we find out what you recommended in the past? Roger, again, go to our website and you will find a complete trade history of our service for the last 9 years. It's about 2,000 trades we've done over almost 10 years, and you can see that we're active in every asset class all the time, long and short, as well as focusing on the best sectors, the best half dozen or so sectors out of the 100 or so that are in the S&P 500. So just click on the chat box on the right to get this one-time only offer. Let's see. Here's another one. Elizabeth in Montana. Do you ever get to Montana? I don't really. You know, my family owns a huge chunk of land up there. They got a great deal on it right after Custer's last stand. I think they got it for like $1 an acre. Still in the family. It turns out they're all rich up there because they had coal on all that land, and now they're fracking for natural gas. So talk about being lucky. It's all about location, location, location. The Fed is not going to bring back QE anytime soon, but when we do go in the next recession in 2 or 3 years, some people are saying as early as 18 months, then we will get negative interest rates in the US like they had in Europe last year, and we will get more QE. With interest rates this low, they're basically useless as a stimulus tool because they've been low for 10 years. We all know that negative interest rates don't work over the long time because Japan has had them for 25 years. So that's when you get your next QE. Also, we'll have a new Fed governor by then. Janet Yellen retires in January, and the president almost certainly will bring in a new guy like Gary Cohen from Goldman Sachs. Okay. Any other questions here? Okay, we got this one. We got this one. Okay, Jeanette, are you there?
Hey, John, I'm here. I saw a question about is there an auto renewal of the 3 months for $4.97? Maybe explain the membership and how that works for them.
Well, you get a 3-month subscription for $4.97, and that's it. There's no auto renewal. We'll invite you to subscribe for $3,000 a year after that, but it's your decision whether to go ahead with it or not. Most people do because they've made a ton of money and the subscription has paid for itself. And by the way, the last 2 subscription rounds we did, the new subscribers paid for their entire year on the first day. We shot out a trade alert, which just immediately went up. The last one was Home Depot. The one before that was the GDX, the Gold Miners Index, where people literally made the cost of the entire service within 24 hours. We can't promise that going forward. For a start, today's Saturday, so the market's closed. We're not going to issue any trade alerts, and we are fully invested now, but we haven't had any complaints about performance recently. Okay, any other questions? We still have a couple minutes to go.
I saw a question about soybeans. Is soybeans a buy right now? What's your opinion on soybeans?
I have not touched the soft commodities for 5.5 years, and I fall down on my knees every day and thank God I haven't touched them because that market has been a disaster. Farmers are just too good at their jobs in the United States. They keep producing more and more for less and less money. The result is that the downward pressure on prices has been constant and never ending. You're now looking at a near perfect year for almost all agricultural crops. They're all pushing new lows, new 5-year lows. So I would just say stay out of the way. There's just too many better things to do in bonds and equities and in the precious metals. So I would say no. Don't confuse something with gone down a lot with cheap, because it could get a lot cheaper. And remember, in ags also, you get these huge limit moves of 10% or so at a single day, where you get locked out of the markets. You can't bail out of longs, and that's a great way to get wiped out. Did I answer that clear enough? Okay, let's see. I'm going to go through the question box, see if we have any more questions here. Let's see. Yeah, let's see. Got that one. Got that one.
Hey, sorry, I was muted.
Oh, I didn't.
Did you see the question about recession? When the recession?
No recession. The most aggressive recession forecast right now is for 18 months. That assumes that we keep getting quarterly interest rate rises of 25 basis points. But if you get a new Fed governor in January, he may be more aggressive on rate rises, and that would bring a recession sooner than later. Remember, the outgoing Fed governor, Janet Yellen, whose class I used to take at UC Berkeley, has been the most accommodative Fed governor in history. So we're not going to get the free lunch we had under Janet with future Fed governors. I would expect to get much more aggressive rate rises under the next governor when he comes in 6 months.
So there's a question here about Brexit. Your knowledge of macro issues is amazing, John. Please tell me your opinion on Brexit.
I think they're not going to do it. I think that what's going to happen is Britain is going to go into a recession. It's going to be lead to thousands and thousands of job losses. And in the meantime, you're having a big demographic change in England, where the old people who voted for Brexit die off and the young people who were against Brexit attain voting age. You carry that on for 4 years and you have enough to change the outcome of that election. So I think they will have another election in a year or two. They'll vote against Brexit because the costs are just going to be too high, and that'll be the end of it. And even if, you know, they carry ahead with Brexit, they won't even start to implement the major measures for 3 to 5 years. So this is a long-term thing, and I think the British will regain their sanity and vote against Brexit a second time. If they don't, it'll end to the demise of their economy. Is that clear enough? Okay, I have 2 more minutes to go. If you have any other questions, just type them into the question box. If not, you can just go straight to our sales page at madhedgefundtrader.com/TradeThirsty. Just click on the blue link on the right in the chat box, 3 months for just $497. And if you have questions on any other asset classes, I probably have time for just one more. Here's one from Bill in Boston, Massachusetts. Will the hurricane affect the economy? This is the deal on hurricanes, Bill. Always a short-term negative for the economy, always a long-term positive, because the rebuilding spending acts as a local stimulus for the economy. That is a positive over the long term. So, but you won't see that in the numbers, the economic data releases for probably about 3 months. By the way, I understand every Home Depot in the state was cleaned out of building materials. So another reason to own Home Depot, we kind of lucked into that one. For hurricane forecasting is not within my skill set. Okay, Jeanette, anything else? Any other questions? Any other questions about the service? Okay, well, I see I have about 30 seconds left. Thank you for joining me today. It's been a pleasure. Love your questions. I don't think I've ever heard a question I couldn't answer unless it's about a microcap stock that I've never heard of. So look forward to working with you over the coming year or the coming 3 months at the very least. Jeanette.
I am here. I'm here. I keep muting my microphone and forgetting that it's muted, and I'm over here just talking, and I realize you don't hear me.
Talking to yourself.
Goodness gracious. All right, John, thank you so much for coming and spending this Saturday with us. We really appreciate you. His link is madhedgefundtrader.com/TradeThirsty.